incredibly, this PPIP program that the government is promoting and that there are 9 managers trying to raise money for, they are looking to take your money and our retirement money and all our money and buy those AAA bond classes. And they're using gimmick leverage from the government to say, well, there's a fantastic going in current yield, but that's the oldest game in the book, right? Selling someone on a current yield, kind of seducing them with current yield, and then leaving them holding the bag at the end of the day. And so here's kind of what I think things are worth based on my crude analysis. I think the junior CMBS and the mezzanine CMBS are worth nothing more than just kind of whatever cash flow you can put in your pocket until the loans actually go into default. Because when they do, you're wiped out. So somewhere less than 10 cents on the dollar would be what I would consider fair value for those bond classes are. Now, you might ask, where are they trading? Well, they're trading the junior CMBS, which by my estimation is around 120% loan to value on average, is trading somewhere between 35 and 60 cents on the dollar. Okay? And the mezzanine AAA, which I calculate as being around 106% LTV on average, and again, I think these are generous, is trading somewhere between 50 and 70 cents on the dollar. And the super senior bond, which I think is worth no more than 72 cents on the dollar, is trading somewhere between 90 cents and 100 cents on the dollar, depending on this particular deal. So there are people who made a lot of money buying this stuff at its bottom and riding a rally. But we all have seen a rally in the last 3-4 months in assets, in financial assets. Stocks have rallied unbelievably. Bonds have rallied unbelievably, not just in CMBS, but high yield bonds, corporate bonds, everything. Everything's up a lot. And you have to ask yourself, why, right? I mean, what's that all about? And from my perspective, and I'm not here to give you investment advice, but I feel that there's far more downside risk than there is upside risk. I can't understand why, given the rally we've seen over the last 3-4 months, why everyone's not running to sell everything they own at today's prices. Because, you know, where is it going to go from here? Where is the economic activity and the employment gains that really are needed in order to have a sustainable, strong economic environment and have valuations that are supported by an economic environment like that? So that's all the bad news on the old stuff, and I want to talk about TALF a little bit and the new normal, right? Because I think securitization will continue to exist for a lot of reasons. I'm happy to answer that in a Q&A if you want. TALF is a government program. Anything with an acronym we know was cooked up by the Treasury Secretary. He seems to like acronyms, you know, these. And so TALF is a program that is designed to provide leverage to bond buyers, AAA bond buyers. And let me tell you something, I will criticize things that I don't believe are good, but I think ideally TALF could be very, very valuable. It has been valuable as it's been applied to other asset classes like auto loan securitizations, credit card securitizations. It has not yet impacted new loan originations in the commercial real estate arena positively. And the reasons are really twofold. Number one, because we've had this big gap between the bid and offer. So there's just not a lot of activity to finance in the commercial real estate arena these last months since TALF was introduced. But also there's aggregation risk. TALF, so if I'm a lender, for me to get a AAA bond backed by loans, I have to have at least $500 million worth of loans. Well, there hasn't been a lot of volume of loan demand today. So the question is, when will I have enough loans aggregated to go to the rating agencies, to get the rating, to go to the bond market, to sell to the bond buyers, who will then go to the government and borrow? And because volume is so low today and unpredictable, it's uncertain how long that aggregation period will last. Unfortunately, TALF was just extended but expires June of 2010. So that means there's roughly 9 months between now and its stated expiration. And frankly, aggregators of loans can't count on TALF being in place because of this uncertain amount of volume. So unless TALF's extended beyond June of 2010, it won't have the impact that it could otherwise have, which is to stimulate a lot of lending. Now, if they extend it, which I wrote a letter to the person in charge of Treasury 2 days ago, who I know, to explain to her why it's imperative that they extend it if they want to have any impact at all. But if they do extend it, which I do believe they will come around to doing, this is how I see securitization-based lending looking going forward. I think that one of the major changes in securitization will be that loan originators will own the loan. They won't just package all the risk and sell it off to bond buyers who don't really have the capacity to underwrite risk and are trusting the rating agencies. That game is probably over, and that's a good thing. I think what we're going to see are funds like mine, lenders that are oriented towards good credit underwriting and have the desire to own a loan to maturity. That'll serve the borrower's interest very well, because one of the failings of securitization is the borrower has nobody to talk to, right? That's why many borrowers hated the whole securitization model, because they don't have no one to talk to. And if you look today, you know, it was bad enough when things were going good. But when things are going bad, who do you talk to becomes a much more exacerbated problem. The special servicers have seen their economic interest in the loans wiped out. And now, as loans go into problems and defaults and delinquencies and decreased NOI and tenancy problems, calls into the special servicer can't even get returned, because the special servicing fee is fixed, and they can't hire enough people with that fee to actually service the needs that were unanticipated of a troubled loan market underlying these bonds. Because the whole model of CMBS was created around a notion that we would have a continued bull run, 1% delinquencies, 2% delinquencies, very little actual losses. And that's what the special servicers model based on. So that needs to be fixed. But in the future, as we emerge from this, lenders will be lenders, right? You're going to get your loan from a firm like ours, CBRE Capital Partners, or other firms. And you're going to have someone to talk to, because they're going to own the loan to maturity and they're going to service the loan to maturity. But they're going to use the capital markets the way it really ought to be used, which is to leverage their loan. So they're going to sell, let's say, AAA rated bonds, which are match funding leverage against the loan. Perfect match fund. And the AAA bond buyer, who typically needs and relies upon leverage him or herself to get the desired leverage return, used to rely upon Wall Street to provide that leverage, now is relying upon the government through the TALF program. And so this is kind of how TALF was intended. As I said, unless it's extended past June of 2010, it won't be effective, but I do believe ultimately will be extended.